as
This
we enter
conference
into
will
the
now
end
be
of
recorded.
the day. The feelings are mixed. I would request Agnish to make me the presenter and organizer so that I can share the screen with you all. Agnish, please do the needful. Are you there, Agnish? Can you make me the presenter? Yes, Agnish, can you make me the presenter? Good evening, everyone. Yeah. Now you can see my screen and you can see me live as a cup of coffee. Life is beautiful. Live it. Don't think of what you don't have. Love the things which you have. Make the best out of it. These are golden words. Your best is yet to come. Always believe and always believe that you are going to be a champion. On that note, let us start the revision. Learn to enjoy what you have. Don't think of what you don't. Never give up. Today is hard, tomorrow will be worse, but day after tomorrow there is going to be sunshine. So what did we do? We learned about the two strategies, directional as well as non-directional, right? So a lot of students ask me, sir, I don't know how to use a directional strategy. So today I'm going to teach you CP momentum trend setup, which is made by me for directional markets. Okay. So what is a directional strategy? Directional strategy, when you know the direction of the markets, whether it is going to go up or whether it's going to go down. Either through the help of technical, through the help of fundamental analysis, you can predict with a certain degree of accuracy. Non-directional strategy, when the trader does not know the direction of the market, but believes that the market is going to remain in a range or a very big movement can happen either side, right? These are the two styles of using option strategies. So we did the first one, bull call spread. How many of you have practiced a bull call spread? +1, -1. Higher premium bought, lower premium sold. Limited profits, limited losses, right? Limited profits, limited losses, good risk reward ratio. It's an excellent strategy. If you know the direction, it is an excellent strategy, right? +1, -1. Same underline, same expiry, same number of options. So what is the leg 2 strike you're going to sell? Leg 2 strike. Which one? Out of money. Manasda, how is your revision going? Option chain, highest open interest. So today I think so Meena ma'am made one strategy, right? 16,100 call sell, 15,850 call buy. Who made this? Meena ma'am? Manasda. So Manasda, if I look here, I can clearly see 16,000 call. Highest open interest, round figure. It is not going to cross that easily. So I would prefer to sell a 16,000 call instead of a 16,100. It's not about risk reward. It's also understanding what is the expectation where the markets can go up for this expiry. Am I making sense? Good. So if I'm bullish, 15,850 call I might buy at the money. and I might sell 16,000. Right. So let me go down. Any question regarding bull call spread? So how am I getting this? This is A, buy. This is B, sell. This is the combination of A and B. Right? Am I clear with this? All of you? Good. Now the next one. Vijay sir, how is your revision going? Bull put spread, 2-leg strategy. Use when the direction of the market is bullish. I showed you last class, if you are doing a bull call spread and a bull put spread with the same strikes, what are you getting? Same results. Same results. Bull call spread and the bull put spread, I'm getting the same Greeks, right? Hardly much. I answer 5-10,000 rupees, nothing much. The margin difference is not very high, but the result is the same. So in a normal case, I'm going to do a bull call spread and not a bull put spread. So when will I do a bull put spread? Welcome, Meena ma'am. I can see your revision. Precision. 65%. IBP greater than 65. I will sell a out of money call. Higher premium. Sorry, I'll sell an out of money put. Higher premium. I will buy far out of money put. Lower premium. So if I feel that Nifty has a strong support of 15,800, I might sell the 15,700 put out of money and buy the 15,500 if the IBP is greater than 65. That means option premium are expensive compared to the past data. So when I do this, what is the delta? Positive. So whenever directional and bullish, delta is positive. In this case, theta positive, gamma negative, vega negative. Am I making sense? Are we all clear? Lovely, Aman Bhai. Very good. Kuldeep sir, how is it going? So when I sell a put, my friends, how I plot? Like this. Are you not well, Kuldeep Bhai? When I'm selling a put, when I'm buying a put, it is B. When I combine this A and B together, what do I get? Something like a bull call spread, right? Good. There is nothing called ideal. I answer, it depends on your view. Siddharth sir is saying daily morning 11 o'clock put and call writer is getting changed. Siddharth sir, Every minute the put and the call writing gets changed depending on the markets. So sir, are you new to my class? I haven't seen you for long. Are you attending today? Or were you seeing the live recording? Okay, you were there. Probably I might have missed you. So Siddharth sir, this changes. Okay, you was there. So have you seen the recording? Good. So Siddharth sir, with the market conditions in the live class, if you see the recording, we were jotting the put call ratio. So this put call ratio helps us to find out the market trend in that day. If there were more put writers to the call writers or more call writers to the put writers, we were trying to predict with the help of the put call ratio and the highest out of money open interest strikes. So that process and method we apply to trade in the markets. Right? So if you have time, go through the video of the live market session. Good. This will not change only at 11. It will keep changing every 20-30 minutes depending on the market condition. So you have to keep jotting the put call ratio and other details to find out the market trend. Good. Bull put spread. Am I clear? Now we come down to the third one. Bull call ratio back spread. When I'm extremely bullish and I'm expecting movement in the bullish direction, what am I doing? Call ratio back spread. -1 higher premium, +2 lower premium. So I'm selling a call, higher premium, buying 2, lower premium. Right? Now what is the purpose? I'm very bullish. So what is the chart like? Net premium. Your maximum loss is the strike B, where you have bought both the calls. The maximum strike is the strike B. -1 +2. All strikes belong to the same underlying, same expiry. Lovely Meena ma'am. The reason why we are taking minimum 20 to 22 days, 24 days for the expiry is the theta loss is very high in this strategy. Delta positive, theta loss is extremely high. Vega and gamma are in our favor. So that is why we are holding this position for a maximum of 4 to 5 trading sessions. Now, what is the difference? The important thing here is, if you make a strategy here and there is a big movement on the upside, so you have substantial scope of an unlimited profit. If the movement happens on the downside, limited loss, and predefined loss if the market stays in the range. Predefined loss if the market stays in the range. So what am I looking for? I'm looking for either a very big movement on the upside or a very big movement on the downside. So when I'm looking at these two, what did I tell you? Where can you make this strategy? Where can you make this strategy? Big gap down. Did I tell you? When the market opens gap down, big gap down, and if it is reversing, I can make one, or at the close of the day. I showed that. we have seen that when there is a big gap down, and at the close of the day when we make it, if the market does not recover, the next 3-4 days, either the market goes down or goes up substantially. I answer, have you done a research there? If not, please look and do the research. Whenever there is a big gap up or a gap down, there is a substantial movement either side. There is a substantial movement either side. All of y'all, please have a look. Am I making sense? Where is the maximum loss? Strike B, where I have bought the 2 calls. So what is the break-even point? The distance between A and B you add to B plus the net difference of premium. Plus the net difference of premium. I hope you have seen all the examples we did. I have shared the Excel sheet with you all. Right? So let us see this. That was a bull call spread, bull put spread. This was a bull put spread, call ratio back spread. See here, we have sold the 35,000 call, bought 2 of 35,500. Right? So what was the break-even point? 35,500 minus this difference, so 36,000 plus the net difference of the premium, so 36,425. From this, I will add the difference, so 35,500 minus 500 is 500 points, 35,500 plus 500 is 36, plus the difference of these two, so 36,425 was my break-even. So it went up. If it went down, my loss would have been lower. If it went up, my profit is unlimited. Only if it stayed in this range can you see my losses on the higher side. Am I clear? So what is the difference between this and a bull call spread? I answer, what is the difference? In a bull call spread, if the market falls, I will have a limited loss. If the market goes up, limited profit. Here, if the market falls also, my loss is very small, Kirti ma'am. But if the market goes up, my profits are unlimited. Only if it stays in a range, I will have a theta loss. Here, my theta loss is neutralized in a bull call spread. Am I making sense? Am I clear? Good. Yes, Rahul bhai, how is the revision going? Neutralized theta means the money which I am losing when I am buying a call because of theta is being gained with the other strike call which I am selling. So my theta loss gets reduced. Now we come down to the bearish strategies, mirror opposite of the bullish strategies. You remember in the bullish what we did? Bull call spread. In the bearish, what is it? Bear put spread. So when I'm bearish and I'm expecting the markets to come down, what am I doing? I am doing a bear put spread. So what is a bear put spread? +1 higher premium, I'm buying a put. -1 lower premium, I'm selling a put. Right? It can be in the money, out of the money, at the money, out of the money. Right? So buying a put, leg 1. Selling a put, leg 2. All puts belong to the same underlying. same expiry, same number of options. Now Ketki ma'am is bearish in the market. Ketki ma'am is bearish in the market, right? She believes that Nifty is going to fall by the 15th of July. Not immediately, by 15th of July. So what does she do? She buys a 15,800 put. Now Ketki ma'am goes down to the monthly option to see where there is out of money put writing. Can you see 15,500, 29th of July? Very strong open interest, 51,973. So she feels that 15,500 is a strong support, highest put writing. So what does she do? She sells out of money 15,500 put. Right? So when you're buying a put, 160. When you are selling a put, you receive 70 rupees for calculation purpose. Right? So 91 rupees is the investment Ketki ma'am has made. So when she's buying a put, 15,800. When she's selling a put, 15,500. So when she does it totally, it becomes like this. 15th of July she has done, I answer. She saw the 29th of July to find out what is the probable support. Because 15th in July, open interest is not very high. Right? Now this is the trade. What is the maximum loss? Premium paid 91 into 50. Are you aware from the 1st of July, the lot size has changed? 91 into 50. Right? So her maximum loss is close to 4,600. This is wrong, 4,600. Maximum profit, 200 and total payoff is 300 rupees minus the premium, 90. So 210 into 50. Right? So somewhere around 10,300 or 500 is the maximum profit. Limited loss, if the market remains above 15,500, limited profit from 15,500 and below. Right? What is the Greeks? The same way. Delta negative. Theta slight negative. Adjustment. Gamma positive, vega positive. So can you see this? Directional trade. Directional trade. Am I making sense? So when you are bearish, this is what you do. But always remember, this is as a strategy, you're ending together. You will exit together. So what is the break-even point? The first strike, 15,800 less the combined premium paid. So 15,800 minus 91 is 15,709. Can you see this? So below this, up to 15,500, I will be in profits, but my maximum profits will freeze at 15,500 and below. Just can you see this? It is freezing here. This is bear put spread, mirror opposite of a bull call spread when you are bullish. You will make money when the market goes down, limited loss if the market stays above the strike price you have bought a put. Any questions? Good. So my understanding here is that the challenge which I was talking to quite a number of y'all is that you don't know when the market is directional. So that is more of a technical question. So I have tried to answer this question today through my eyes. I'm not perfect. Please, the caveat is whatever tools I've used, this is through my understanding. So after this 2 directional strategies, I'm going to discuss with you all. Bear call spread. So my friends, please take a photograph. Bear put spread. Take a photograph. The advantage is the margin benefit. We have discussed this already. Is the photograph taken? Please take the photograph of the Greeks. Is it taken? Very good. Have you all posted in the group? Is it posted? Quick. Thank you. So now, same way, bear call spread. I'm bearish in the market. I'm using a call instead of a put. And the spread is the difference of 2 contracts. The difference between a bear put spread and a bear call spread is bear call spread is a net credit strategy. So whenever, my friends, you are doing a strategy and you are receiving a net premium in your house, it is called a credit strategy. Whenever you're paying premium from the house upfront, it is called a net debit strategy, right? The difference of the premium. So what am I doing? -1, higher premium, +1, lower premium. I'm selling a higher strike call, higher premium, and I'm buying a lower strike call, leg 1, leg 2. All strikes belong to the same underlying, same expiry, same number of options. So similar to what we did as bull call spread and bull put spread, same thing we are doing as bear put spread and bear call spread. Similar things, right? So now let us see this. Let us see this example. Just in this example, I'm changing this to call. I'm buying a call of a lower premium. And I'm selling a call of a higher premium. So can you see this? Is the payoff same? Is the PL and the Greeks very similar? So Manasda, if I am doing, Satish sir, I will not use this strategy in normal cases. Very correct. If I am bearish in the market, I'm not going to use a bear call spread. I'm going to use a bear put spread. But if you see up, if this IV percentile is greater than 65, that means option premiums are expensive. And I know that there is a resistance in the market. I know that there is a resistance in the market on the upside. So what will I do? I'm going to sell a far out of money call. Sorry, I'm going to sell OTM, out of the money call, higher premium. And I'm going to sell, buy far out of the money call, lower premium. So if I understand that the premiums in the markets are expensive, which is not the case right now, so I will avoid. But if these premiums were higher, and I knew that 16,000 is a strong resistance, so I might have sold the 16,100 call at 80 rupees, and I might have bought the 16,300 call at 31 rupees. Since, my friends, the premiums are cheap, my risk reward ratio is not favorable. Since the premiums are cheap, my risk reward ratio is not favorable. So whenever I do these types of trades, I must have a strict stop loss that around 16,100, if the market goes anytime before 15th, I will need to square off my trade. Why? Because if I don't square off, I can have this unlimited loss of 11,350. If you see here, now your Greeks will change. Why? Your theta will become positive. Your delta is negative. Your gamma will also from positive be negative, and vega will be negative. As I went from at the money strikes to out of the money in a bear call spread, my whole concept changed. Now I'm expecting markets not to close above 16,100. So I'm slightly bearish. And since the IVP is greater, I'm expecting the markets not to touch the resistance level so I can make this theta gain. Am I making sense? Very good, Suraj sir. Do you have option experience beforehand? Good. Good. So I will teach you one more strategy which we have done in revision. Is the strategy clear? Mirror opposite. Mirror opposite. See the payoffs also the same, like a bear put spread. What am I doing? I'm selling a call, higher premium. I'm buying a call. Sorry, I did this. I'm selling a call, higher premium. I'm buying a call, lower premium. So ultimately it becomes like this. Is this clear? So basically this is where the data comes in. Very good. So markets are not about prediction, markets are about probability, right? Markets are not about prediction, markets are about probability. We don't want predictions, we want probability. Are we making sense till here? Yes, Ketki ma'am, how is your revision going? Srinivas sir, Sharmila ma'am. Good, good. So now we come down to the last of the directional strategy. Bearish put ratio back spread. Just the mirror opposite. I'm extremely bearish. I'm expecting the markets to fall very quickly. So Sharmila ma'am is expecting Bank Nifty to fall. Personally, I'm very bullish in Bank Nifty. But because Sharmila ma'am, minimum 20 to 22 days, so by default, 29th of July. What is she doing? She's expecting Bank Nifty to fall. So she's selling 35,000 put. Right? She's buying 2 lots. Sorry, I've 35,000. She's buying 2 lots of 34,500 put. Okay, so let us do this in Excel. Okay, Sharmila ma'am is bearish, 35,000 put, minus 1, 34,500 plus 2. What is the premium she is paid? Minus 595, 440. So what is she receiving? 595. What is she paying? 440. Thank you, Kitki ma'am. 440 into 2. See, I told you my maths is very weak. So the net premium offtake is 285 rupees being paid. Right? Now let us see what happens when Bank Nifty is at 36,000. I have sold a put, 0. I have bought a put, 0. No payoff. My only loss is the premium loss. What is my total loss? Premium loss. What will happen at 35,500? 0. Why? 35,000 put. Out of money put. Yeah, it's a debit strategy. I'm paying from my pocket because I paid 880 minus 595. 36, 34,500, 0. 0. Minus 285, minus 285. Very good, Kuldeep sir. I think so. Now you started feeling well. 35,000 at the money put. 0. Add the money. Zero. Zero. Only the premium loss. Right? $34,500. Now what will it be? What will this be? Rahul sir, plus 500 or minus 500? Am I a buyer or a seller? Thank you. Minus 500. Why? I have sold 35,000 put and it has closed at 34,500. This will be 0. 0. Minus 285. Oh, I'm so sorry. Minus 500. See, I told you I'm so weak. Now, what will happen to my 35,000 put when Bank Nifty closes at 34,000? What will happen? In the money put, minus 1,000. Thank you, Satish sir. What will happen to 34,500? Plus 500 into 2, Satish sir. Thank you. 0. Only the premium loss. 33,500. 1,500. Thank you, Mukesh bhai. You see, my maths is very weak. 33,000 minus 200 or 2,000. Thank you, Rahul bhai. 5,500 plus 3,000 plus 1,500 minus 285. So can you see this? If I draw this, my loss is minus 285. It increases to 785 at 34,500. Slowly, slowly, slowly. So what is my break even? Difference of the two strikes. So 34,500 minus 500 minus the premium paid. 33,715 is my break even point. Right? So if I see here, see this break even, see the same way. Loss of 285, maximum loss at 34,500, and my break even is unlimited profits below 33,715. So all you add the premium to the strike price, and in put you subtract the premium to get the break even points. Am I making sense? Am I clear? What are the Greeks? Delta negative. Theta, can you see theta? Substantial loss. Gamma positive. Vega positive. Right? So when will you do the strategy, my friends? When will you do the strategy? Substantial gap up. Can you see this? Infosys 1441 at close and next day opened at 1477. Can you see in 3 days It fell by 100 points. See here, substantial gap up. At the close, I made this position. 1, 2, 3, 4, 5. So either way, the market should either fall down. If the market is not falling down, the markets should go up. Take this case, if I would have made here, I would have lost money in this strategy. Substantial gap up. If I would have made here, the next 4 days the market did not do anything. Am I making sense? Am I clear? I will just show you Bank Nifty. So if it is risky, I will trade less, right? So can you see this here? Substantial gap up. At the close, I made the strategy 1, 2, 3, 4. Market went up substantially, right? Markets went up substantially. Can you see here? Gap up. 1, 2, 3, 4. Markets went up substantially. Can you see here? Substantial gap up. I did it as it covered. 1, 2, 3, 4. I would have made very big money here. So if the market is moving, I have no problems, right? As long as the market remains in the range, there can be a problem. Can you see here? Substantial gap up. It closed at 24,523, opened up at 700 points gap up. 1, 2, 3, 4. Next 4 days, same day, it gave you money. Is this clear? Any questions? So now, I was thinking, a lot of people said that, sir, though we have the money, but we don't have money to do the short straddle, because the short straddle gave fantastic profits. Those people who attended my Nifty webinar, they know that substantial profits have come in Nifty than Bank Nifty. Bank Nifty has also given money, but Nifty there were substantially higher profits. Okay, so now I have taken out for the bull call spread and the bear put spread. I've taken out a new strategy which is called the CP trend momentum setup. This is positional strategy for bull call spread or bear put spread. So what am I using? I'm using Bollinger Band 50 SMA. So if I go down, take you to trading view. This is trading view. Can you see this? I'm using Bollinger Band. What is the period? 50. Close. Standard deviation is 0.7. Now if you notice here, my friends, when the market is in an uptrend, do you see that the prices are above the upper Bollinger? Do you see that? When the prices are in a downtrend, do you see it is below the lower Bollinger? Don't see the green line, not required. Yes? Is this clear? This is the upper Bollinger. This is the Bollinger Band. So I've decided the trend. If the market is up, prices should be above the upper Bollinger. If the market is down, it should be below the lower Bollinger. Is it clear? So now at least you know the trend. So now you know that I will make a bull call spread if other conditions are met and if Infosys is above the upper Bollinger. Meena ma'am, Kavita ma'am, Jivyanti ma'am, are we all making sense? Good. So now the second point, PROC. What is PROC? Price ROC is rate of change. What is today's change? Can you see this period? 5. I put 5. Today's change compared to the last 5 days close. Today's change compared to the last 5 days close as percentage. So whenever a big movement, can you see here? Whenever a big movement is happening, there is institutional money coming in. Can you see here? How do you define that big movement? I answer, how can you define the big movement? Can you see this indicator? This is ATRP. What is ATRP? Average true range percentage. So the average true range is size of candle, high minus low. When I'm taking 14 days, that means last 14 days, high minus low, as a percentage. As a percentage. Last 14 days low as a percentage of close of that day. So what is the average candle size? 1.7. So can you see here, whenever your PROC is greater than 2 times ATRP. So that means if ATRP is 1.5 into 2, 1.5 into 2. So whenever your PROC is greater than 3%, money flows in. Can you see what is your PROC here? 4.42. And what is your ATRP? 1.57. This is called momentum. Someone has bought aggressively. So whenever your PROC is double than that of ATRP, and whenever the close is above the upper Bollinger, and this close is greater than the last 3 days close, I will buy on this close. So what will I do? I will do a bull call spread. Now the beauty of this system here is, I will not sell. When will I sell? My exit is, I will note the low when the 5-period ROC is less than 0. Can you see? When this period goes below 0 ROC and that low gets breached, just see here. Here also this momentum call was generated. Now just see ROC. Can you just see ROC? It did not go below 0. Now here, my friends, the ROC went below 0. I will note this low, 1313. Only below this level, I will exit. Just see here. Now, this is where I will exit, below 1375. Next day, I exited at 1336.40. Am I making sense? So once you've entered, till the 5-period ROC does not go below 0, that means today's close compared to the last 5 days close, if it is not negative, I will not exit. So all the momentum I can ride. So can you see this is riding the momentum? Just see Adani. Manasda, take a higher expiry. Can you see this, Adani? This is where the momentum came in. You enter here, even in the cash stock. Whole ride was seen. Right? The whole ride was seen. So this strategy gives you very big profits. That is why the term momentum is used. Can you tell me which stock right now it is in? Maruti has given a buy the same momentum call. Just see this. Just see here. 2 days back. Just see this. 1.99. That means it has to be greater than 4. Can you see? 4.48. Close greater than the last 3 closes. On the closing, I made Maruti 7527. Sorry, this was the one 7432. I would have made a bull call spread. So I will continue this till this does not go below 0. Once it goes below 0, I can exit on that day or the next day. Very good, Meena ma'am. It is an inverted head and shoulder pattern. Very good. You are sharp. Right? So with this momentum strategy, you can get an exit. Manasda, make a bigger spread. So what spread can you make? See Manasda. No, I don't want to reduce the zigzag. I want to keep it. I will only act only when it goes below 0. So I'm not bothered about the zigzag. When my today's close is below the last 5 days close, the momentum is over. I will sell if the low of that day is breached. When today's close is less than the last 5 days close, I might sell on close because the momentum is over. I will book my profits. This is the problem. Let us go to the old site. So how did you like this strategy? I'm not a technical teacher, but this is my understanding of the markets. Right? So if I'm trading in Maruti and I know that Maruti can go up to 8,000, so what will I do? I might buy a 7,700 call sell a 8,000 call, or I might buy a 7,800 call and sell a 8,200 call, right? Because I'm expecting these sort of momentum give you a 5 to 10% rise. So these are not Manasda small moves. When you get this, 500, 600 points in Maruti is quite possible. Yes, 500, 600 points moves is quite possible. So always remember bull call spread, bear put spread. You require the principle buy higher, sell highest. I'm buying high here. I'm buying here with a high. As Meena ma'am said, inverted head and shoulder, neckline, minimum target here, 79 to 8,000, right? That's your minimum target. And I have enough days for the expiry, right? Important thing is this is a positional trade. This is not for short term. So at 7,500, I can buy the 7,700 call, sell the 8,000 call. Is the strategy clear? So what are the ingredients? The ingredients are Bollinger Band 50 by 07, PROC 5 period, ATRP 14 period. So the close greater than the last 3-day close, the PROC should be greater than 2 times the ATRP. Close should be outside the Bollinger Band. And if the future open interest is also high, it gives you the signal that there is long position build up. So when the low of the 5-day period ROC is less than 0, if the high 5-day ROC is less than 0, you will exit when the low is breached, or you can exit on that day's close itself, because the momentum is over. The momentum, the market will keep on going higher or keep on going lower. That is called momentum. The moment the 5-period ROC is touched, the story is over. That means the momentum is over. So you can exit there. Right? Hope you like this strategy. So this is called a momentum-based trend following strategy. It's very simple and it works well with bull call spread and bear put spread. Good. So congratulations, friends. We have done the directional strategy. So what are the directionals? Let's revise. Bull call spread +1 -1, higher premium, lower premium. Bull put spread -1 +1, higher premium, lower premium. Bull call ratio back spread -1 +2, -1 higher premium, +2 lower premium. Right? Now we come down. Bear put spread +1 -1. When you are expecting the markets to fall, higher premium put you're buying, lower premium put you're selling. Bear call spread -1, higher premium, +1, lower premium. Last one, put ratio back spread -1 +2. Higher premium you are selling, lower premium 2 strikes you are buying. Now we come down to the non-directional strategies. Any questions regarding directional strategies? Yes, Sharmila ma'am. Yes, Shaikh ma'am. How is your trading going? Have you traded or have you stopped trading? Are you doing the golden bank nifty strategy? Shaikh ma'am. Rishabh, how are you? Very good, Meena ma'am. Shaikh ma'am, money is secondary. For me, Shaikh ma'am, is your time is more precious than your money. Avoid doing the ratio backspread in stocks. Manas sir, avoid doing the ratio backspread in stocks. You are too new right now. I will tell you which strategies to be done. Very good, Meena ma'am. So, Meena ma'am, today I have taught you one more strategy in TradingView. Siddharth sir, I think so. You are behind the class. This Excel sheet is all with you. All the Excel sheets have been sent to you. Right? Just check your mail. Anish has sent you all the Excel sheets, in fact. Nice, you've joined the class at least. Good. Bhavna ma'am, you can use this in investing also. Yes, why not? No, investing also you can do. Why? Oh yeah, okay, I answer is correct. ATRP is not there in investing. Good, thank you for reminding me. ATRP indicator is not there in investing. Ami broker, I'm not sure. I haven't tried. Thank you, Bhavna ma'am. Thank you for raising the question. I'm a little too weak in technicals. I'm learning. So, Bhavna ma'am, when can you train me? Yeah, it's a built-in indicator. It is a very simple indicator. ATR divided by percentage, close into 100. ATR divided by close into 100. ATRP. I don't suggest I answer. There's nothing. You have to try both. Which is good, follow that. It should suit your temperament, sir. I am nothing. So answer. I hope you guys are liking it. Okay, Ketki ma'am has brought in another suggestion. Charting. Ketki ma'am, I don't know whether these indicators are there or not. Okay, now we come down to the first. So answer, you should guide me. Why are you asking me? Check Ami broker and guide me whether it is possible or not. Right? Good. So tomorrow give me the answer. Non-directional. When I'm expected a narrow range movement or a big movement either side, like the budget or the elections. We did the long straddle. Is this clear? We did the long triangle. Meena ma'am, Ketki ma'am, Sharmila ma'am, everyone, do you remember this? Live examples. अरे राहुल सर long straddle or strangle किए थे. Delta neutral. Do you remember or you forgotten? Right? Now, very good, Meena ma'am. You remember. Now, we also did short straddle and strangle intraday. They are called range bound strategies. Right? Now, other range bound strategies are butterfly, condor, Ivan condor, and calendar spreads. We have done 3 of them. So let us start the revision. Butterfly. Yes, Bhavna ma'am, please ask. Quickly, quickly. Because for me, your 1 minute is like 1,000 diamonds. Bhavna ma'am, I've explained to you, when you make a strategy in Nifty, like a bull call spread or a bear put spread, your exit will be from the Nifty underlying price, not from the strategy price, not from the options. So whenever you make a strategy, your exit will be from the underlying price. If you have made a bull call spread in Maruti, and if Maruti falls below a certain level or a certain indicator, you will exit. Is this correct? Before I come to condor, I'm starting with butterfly. So there are 2 good news for you all. One good news is we are coming up with an advanced option module for live traders. So those traders, after this class, if you all want to think, if you think you want to make this as a living, we are going to make like this type of momentum strategy I showed you. We are going to make 3-4 models and backtest these models on stocks and indexes. And we will have another course which will be a short duration course. But it will not be right now because I'm too busy. Might be in October or November. We might plan something for only our TMP, AOT students who have done option classes. Right? And the second one is we might have a live trading session for Nifty and Bank Nifty short straddle for 2 days, where some directional and some directional strategies will also be learned and done through backtesting models. So there are 2 news. So these are all. Yeah, this course is good enough. Absolutely. But Purva sir, Purva ma'am, there are basically people who want to take it to the next level. Full-time trading. So it is for them. So if you are a part-time trader, no problem. But if you want to do full-time trading, you need to be working more on the live examples and backtesting. Right? So there's a difference. So if I'm a part-time trader, it's fine. I've given you the strategies and you're doing on and off. But if you want to be a full-time trader, 24/7, we have to work out. So let us move forward. Butterfly. What is it? Butterfly. Range-bound directional strategies. Buying 1 call, selling 2 calls. In the middle, buying 1 in the 3rd leg. Right? +1, -2, +1. +1, -2, +1. So when will you employ a butterfly, Kuldeep bhai? Point number 1, near to the expiry. Point number 2, where you are expecting markets to be in range bound, where you can predict with a fair accuracy where you are expecting the markets to close for the expiry. So I had this feeling that Nifty will not cross 16,000 last week. But now I have this feeling that this expiry Nifty will close at 16,000. So what are you going to do, Meena ma'am? If you're expecting Nifty to close at 16,000, I'm expecting Nifty to close at 16,000. So what will I do? Since I'm sure that it will be around 15,950, I will buy a 15,850 call. Sell 16,000 call. Why? Because I'm expecting strong resistance there. And expecting the expiry to remain at 16. And I'm going to buy 16,150 call. Single lot. For me, this is a very good strategy. Why? I'm slightly bullish. And my range, can you see what is my break-even point? 15,850. What is the net difference? 63 rupees. 93 I paid here. So total premium I paid is 37. Right? Total premium I paid here is 37. What will be my break-even? Upper strike plus the premium. 15,887. Lower strike minus the premium. 16,113. So if it stays between this range, can you see my loss? Limited. 37 rupees. But if it stays and closes around 16,000, I'm going to make very good money. At the same time, if I look at the charts, also my stop loss is very clear. What is my stop loss? Very clear. Just below the day's low. Now if market is bullish, it will not breach 15,750. It will make a new high. So if it goes below 15,750, I will exit. If it does not, then I will exit at 16,050. Am I making sense? It is not on closing basis, I answer. It depends on your technical view. For me, it should not even go below 15,800. Now my purpose here is enough of consolidation. Market should give a breakout. It has played in a range for quite a long time. And in the next 4 days, if it goes below 15,800, I don't think so. It will go up. See the payoff diagram. Is this clear? So above 15,887 and below 16,100, I will make money. What are the Greeks? So delta neutral. Yeah, Bhavna ma'am, 4 days. Why? Because this is my expiry view. For the 1st July, I see 16,000 closing. Theta, positive. Gamma, negative. Vega, negative. So if the market remains at 16,000 to 16,050, what will be my maximum profit? At 16,000, I will receive 150 rupees. What is the premium I paid? 37. So what is the maximum profit? 113. What is my maximum loss? 37. Is this clear? Good. It's a good trade. For those people who want to try this, you can try this. It's a good trade. Make this position. Any questions regarding butterfly? Now we come down to the next strategy. I can do a butterfly with a call or with a put. The result will be the same, right? Yeah, so that's a butterfly will give you most profits near to the end of the expiry. Any non-directional strategy where you are selling two strikes in the middle, like a butterfly or a condor, the maximum profit will start coming 2 days before the expiry. From there till the Thursday expiry, you will get the highest profits. Yeah, so I answer as one silly question. Let us answer that. Okay, I answer when you are doing directional, you are buying options. So delta is always positive for call, negative for put. Why? Because directional. So delta, call positive, put negative. So whenever you are buying call or buying a put, theta will always be negative. So as a call buyer, your gamma will be positive, your vega will be positive. Right? As a put buyer, delta negative, theta negative, gamma positive, vega positive. So when you are doing directional, what will you see? You will see the same. So for see, long call is always like this. Long put, delta negative, theta negative. So start with normal long call. Now come down to short call. Delta negative, theta positive. Short put. Delta positive, theta positive. Once you have this in your mind, everything else comes in your strategy. Right? Once you have this in your mind, everything comes in your strategy. Right? This is already in the recording, Bhavna ma'am, don't worry. Once you see the recording, everything will come into your mind. It should be in your mind, not in your picture or your mobile. Now you come down to condor. It is a variation of a butterfly strategy to be done very similar to what you are doing, condor, right? Butterfly and condor are together. So what is the difference? +1, -1, -1, +1. So the first and the second strike, bull call spread. Second one, bear call. Lovely Ketki ma'am, bull call spread and a bear call spread. So supposing here I have made a condor, I have bought 15,800, sold 15,950. Sold 16,000, bought 16,150. So let us make a condor with these strikes. 15,800 call. Lovely Siddharth sir, there is a difference. I will just show you the difference. Your maximum profit in a butterfly is at a single point, and in a condor, it is in a range between your second and third strike. So can you see this? So what is it? 120 and 7. I'm paying 128 rupees. What am I receiving? 47 and 31. Right? So 38, 8 and 78. I'm paying 50 rupees from my pocket. In a butterfly, I was paying 37. What is my maximum profit? Between 15,950 to 16,000. My payoff is 150 rupees. My premium paid is 50, so my maximum profit will be 100. Exactly 1:2 risk reward ratio. So what is my break even point? The first strike plus the combined premium. The last strike minus the premium. So 15,850 to 16,100. Beautiful range, 300 points. Very good strategy. In the context, it's a very good strategy. So if you see the Greeks, I answer delta neutral, theta positive, gamma negative, vega negative. So this is a directional strategy. I don't want big movement, limited movement. So I particularly feel that Nifty might close at 16,000 for this expiry. I particularly feel that 16,000 is the most important part. Is this clear? Am I making sense? Good. Meena ma'am, it was simple. I answer, if you want a bigger range, condor is better. If you know the range, if you can pinpoint the range, butterfly is good. It was not that difficult, Meena ma'am. Probably your revision was not up to the mark. No problems. That is why we revise. Bhavna ma'am, I gave the answer just 1 second back. If you want a bigger range, condor is better. If you know that in a smaller range, you can pinpoint a point, like if you feel that market is going to close at 16,000, then butterfly is very good. Then the first strategy is better because the premium outgo is only 37 in the butterfly. But if you're not confident and you feel that the market might stay between 15,950 and 16,000, condor is better. Right? It is Rahul sir, risk and reward. Can you see the reward is more than the risk? So in a butterfly and a condor, the reward and the risk ratios are very favorable. Right? Now we come down to what is an island condor, where the range is very wide. Right? large probabilities of earning a small limited profits. When you know that market can remain in this range, so for example, Meena ma'am is telling me that, sir, I believe that Nifty is not going to cross 16,300 and Nifty is not going to fall below 15,500. She has told me the two boundaries, right? She has told me upside for this monthly expiry 16,300. She has told me the downside support 15,600. Let's make it to 15,500 because 15,600 is too close. So what has she said? She has made a short strangle. What has she made? Short strangle 15,500, 16,300. Right? So what is the premium she has collected? 198. Now what is the drawback of this strategy? What is the drawback? Unlimited loss. Can you see? Unlimited loss. So when there is an unlimited loss, if it goes below 15,500, or above 16,300, right? So in order to overcome this, Meena ma'am tells me that above 16,500, 16,600, she is buying a protection. So she is buying a call 16,600. So can you see the upside now is capped, but the downside is still open. So what does she do? She buys a 15,200 put. Right? Can you see now both the ranges upside and downside are capped? So now Bhavna ma'am, Meena ma'am is not going to wait till 16,400. If it goes above 16,200, she might book her profits. If it goes below 15,500, she might book a loss. But in the meantime, if it stays in this range till the 15th of the month, she will keep this trade on. If you see the range is pretty vast. 15,400 to 16,400. Big range. There is a strong probability the markets can play in this range. If you see the Greeks, delta neutral, theta positive, gamma negative, vega negative. What is the difference here? You can make this trade. Why? If you believe that the markets are going to stay in this range for the next 10 days also, you will make theta gain. But you will have to have a strict stop loss. If either of the boundaries 16,100, sorry, 16,200 or 15,400 is breached, you will have to exit. Is this making sense? Is this clear? Good. Yeah, 15,200 I have bought, but I will exit only below 15,450. I will not wait for this whole range. If I wait, I will be wrong. So Rahul bhai, for me, 15,500 is a very strong support. Last expiry, market reversed from 15,500 last 2 days. If you see the chart, and you see here 15,500, 3 days. So for me, this is a very strong support. I don't see a breach. We saw the option chain. We saw the highest open interest in the put at 15,000. Any question? Iron Condor. Iron Condor net credit. So here you don't have to wait or do near the expiry. You can do any time. So right now I feel that this is a good strategy. Why? Because I'm getting 1,000 points range. Please click a photograph. Please click a photograph. We are going to discuss this in the live class on Wednesday. Please click a photograph. Please send in the group quickly. We are short of time. Is it done? Thank you. Good. We are going to check what is the Iron Condor. Now, on Wednesday, we are going to check this price. So what is the Iron Condor net credit? I received the premium. Condor is a net debit. Both are employed in range bound market. Now my friend tells me that, sir, I want to make a Iron Condor. I expect Nifty to close at 15,950 for the expiry, July 1st. So what is he going to do? He is going to sell the 15,950 call and put. Why? Because that is where he is expecting the markets to be. So he is going to sell the 15,950 call and put. Right? 15,950 call and put. Now what is he going to do? He is going to buy the upper boundary, 16,150. Call. Now he is going to buy the lower boundary, 15,750 put. Now this, when you sell same strike call and put, and you buy the upper boundary and the lower boundary, it looks like a butterfly. Yes, this is called a fly condor, FLY. Same strike call and put. Higher wings. Am I clear? So fly condor will have a good risk reward ratio, something like that of a butterfly. So it's something, a variation of the butterfly. Delta neutral, theta positive, gamma negative, vega negative. Now we come to the last option strategy of the day, which is called a calendar spread. Like the butterfly, like the condor, you will make a calendar spread near to the expiry. Like a butterfly, like a condor, you will make a calendar spread near to the expiry. Right? What will you do in a calendar spread? Can you see the word calendar? Calendar means different strikes or the same strike. What does it mean? Is it different strikes or the same strikes? It is the same strike but different expiry. Same strike but different expiry. My friend Rahul Bhai, he believes that Nifty is going to close at 16,000 on July 1st. So what has he done? The July 1st 16,000 call, he has sold because he expects market to remain at 16,000. Now what has he done? He has bought the far month expiry, either 8th of July or 15th of July or the monthly expiry. Same strike call, but of a later date. What has he bought? Same strike call of a later date. He has bought the call. So he has sold the current expiry call where he is expecting the markets to close for the expiry, and he has bought the far expiry same strike call. So what is the net difference he has paid? 80 minus 31, 49. So he cannot lose more than this amount paid. Now if Nifty closes at 16,000, this will become zero. So this will be at the money call, around 180 rupees. So he will receive 180. So what is this investment? 50 rupees. So his profit is 130 rupees. And his maximum loss is 49. 130, 49. So if you know, like the butterfly, like the condor, if you can predict in and around this level, Nifty will close. I can make a calendar spread. Selling the 16,000 current expiry call, buying the 16,000 call of a later expiry. Now if I see the Greeks, what are the Greeks telling me? Delta neutral because I'm selling the same strike calls. Theta positive because I'm selling a strike where the theta loss is higher, near month expiry. Far month I'm buying, right? Near expiry I'm selling, far I'm buying. Gamma negative. Can you see Vega? What is the difference here in the Greeks? I answer. What is the difference? Gamma is negative for all, but Vega is positive. Can you see butterfly? What was it? Butterfly, this was neutral. Theta was also positive. Gamma was negative. Vega was negative. Condor same. Iron condor same. But can you see here Vega? Vega is positive. Vega was negative. So this is the only change in the strategy. This is the only change in the strategy. Vega impact. So my friends, if you know that on the 7th of July, there is going to be an event. So because of this event, this IV will not fall. So this Vega I will get the benefit. And the current IV will not have an event risk, so the Vega will fall. So supposing in 2024, elections are in May, right? So you know that in 2024 May, because of the elections, the May expiry, IBs are not going to fall. In fact, they will go up. And you know that in the April, at the end of the April expiry, there is no event. So IB will remain static. And you know that in the April end, the Nifty might be closing around 20,000. So can you do a calendar spread? Sell the April 2000, 20,000 call and buy the May 20,000 call. I will get the Vega benefit. So when this event in the latest strike, there is an event like an election or a budget, the premiums will not fall. I will get the Vega benefit. So if I know that there is a range in the prior expiry, I can sell that particular strike call and buy the call of the particular expiry where there is an event. Am I making sense? So let us assume one more time. Let us assume that on the 8th there is a budget, 7th of July. So I know that before 7th this premium is not going to fall. So what will I do? I'm expecting on the 1st of July Nifty to close at 16,000. So if I buy this particular expiry, I know the IVs will not fall. Why? There's a budget to it. So during budgets, we know that the IV does not fall. When the company is declaring a result, we know the IVs does not fall. But on the 1st of July, there is no event in this expiry. So this IV is not significant. Right? So what I'm doing, I'm making a calendar spread here and buying this calendar spread. Same strikes. So I will get the benefit of the event in this calendar spread. Very good, Siddharth sir. This premium on the 1st of July will not fall. So I will get better profits. This will become zero and this will remain high because of the higher IV. Because uncertainty for the event. Am I clear? Did I teach you when the Prime Minister addresses the nation, when the company results are declared, when there are elections, IB shoots up. So when the IB shoots up, the option premium goes up. When option premiums are higher, and if I am a buyer of that option, I will get the benefit. Right? Good. Dividend will not work. Meena ma'am, is this clear? So when there is an expectation that the price is going to be near to a particular strike at close, a calendar spread is undertaken where the same strike of the current expiry is sold and the far expiry is bought. So if near to the expiry this happens, buying far month or far expiry strike, same strike, selling the same strike, current expiry, right? So this is the expiry. So near this expiry, I will make money. I cannot find the exact break even, but somewhere near to that expiry, I will make money. But if it goes far away, my loss is limited to my premium paid. I cannot lose more than the premium paid. The same thing I can create with puts. Buy far, one put, far expiry, sell. So whenever you are making a strategy, Meena ma'am, Bhavna ma'am, Ketki ma'am, Kavita ma'am, Jivanti ma'am, Shaik ma'am, and all others, both will be entered together. Both will be exited together. That is the meaning of the word strategy. You cannot exit one leg and keep the other one. So I cannot just buy this one put. Okay, इसमें profit हो रहा है तो इसको बेच देते हैं, इसको रखते हैं. You can't do that. So at the end of the expiry, so if you have done July 1st expiry, you have sold 16,000 put. In July 8th, you have bought 16,000 put. So you will exit. You cannot keep one leg open. No. So whenever you're keeping that one leg open, you have a stop loss. We have taught you that, Satish sir. Whenever any leg is open, you have a stop loss. Right? You can do anything. You can buy 15 July also. But on the 1st of July, when this expiry is getting completed, you will square off both the trades. So on the 1st of July at closing, if you see this is 0, you will square off this trade. Finish. You will create a new strategy after that. So any strategy which you make all the legs together entry, it's not possible to do it at one go. Few seconds here and there, and exit also together. Is this making sense? Good. So my friends, at 6 o'clock, please take a 10 minutes break. Congratulations, we have completed all the strategies. Wow. 6 directional, butterfly, condor, iron condor, calendar spreads. Right? Good. At 6 o'clock, please be back by 6:10. See you at 6:10. Welcome back. How was your break? Are you all back? How's your cup of tea? Can you hear me? Yeah, Shaikh man. How's it going? Good. So as Kuldeep Bhai has said, we are going to learn new things right now. As Kuldeep Bhai is married, he wants a married put. Before I come here, what is synthetic long? When a market player creates a long position equivalent to that of a long future without the use of futures, with the help of option contract, it is called synthetic. When I create a position without the use of futures, with the help of options, it is called synthetic long. So what is the formula? I can create a synthetic long if I buy a call of the same strike and I sell the put of the same strike. I can create a synthetic long if I buy the call of the same strike and if I buy the put, sell the put of the same strike. So let us take an example. Shaikh man has bought Nifty futures. So when you're buying Nifty futures, July 29th expiry. July 29th expiry. Right? You're buying the futures. Right? Now, very good. So let us change it into a buy. It is a sell. So let us change it into a buy. So the buy will be like this. Right? Now, just see this. Without the use of futures, same strike call, that means 16,000 call, I'm buying. And 16,000 put, I'm selling the same strike put. Can you see this? Was the same chart that like of the same futures? Manasa, if I look at the Greeks, what do I see? The delta of the call, 0.42. Delta of the put, 0.57. When I add the delta together, since the delta of the put was minus plus. So do I know the delta of call or put of any strike combined absolute value is equal to 1? The delta of the call and put. Did you see the delta of 16,000? Absolute value is equal to 1. You remember at the money call 0.5? At the money put minus 0.5. So if I'm selling, it will become plus 0.5. So does it move like that of the future? If you see theta is 0, gamma 0, vega 0. So now let us change. And let us take it 15,500 strike. Call buy. 15,500. Put sell. Do you see the PL is the same? Do you see the Greeks? They are the same. Delta of the call 0.72 minus 0.27 minus plus 1. It is moving like that of the futures. So is this clear? So when I take call and put, same strike, I buy the call, sell the put, same expiry. The payoff is like that of the futures. So which comes and takes us to the call put parity equation. C minus P. C minus P equals to futures. Both same strike, call and put. So like that, this is not a strategy, this is an equation. Instead of buying the futures, if I am buying the call and selling the put of the same strike, it is called synthetic. Without the use of futures, I have created a strategy which will give me the same PL like that of the futures. Any strike, you can choose any strike. I showed you 16,000 call and put, 15,500. Let me now take you to 15,000 call and put. Call I am buying, put and selling. Then you see delta 1, theta 0. So any strikes you can use. Any strike, call minus put equals to futures. So the call put parity equation says C minus P minus futures equals to 0. C minus, so now anybody heard this call put arbitrage? Call put parity arbitrage. So I don't blame you all. In the year 2004, 2005, this was before the algos came in. A lot of people used to do this call put parity arbitrage. C minus P minus futures equals to 0. So now, if I sell the futures here in this equation, this PL should be equal to 0. Can you see here? We are getting a fixed profit of 452 wherever the market goes. So arbitrage is a strategy which gives you a small profit, but no chance of a loss. Small profit, no chance of a loss when you are buying and selling similar instruments. So here, as per the call put parity equation, -1 + 1. I'm buying the call, selling the put, same strike. I'm selling the futures. As per arbitrage, this should be equal to 0. But because of some mispricing, a lot of times when there is a lot of volatility and there is mispricing, the equation is not 0. Since the equation is not 0, there lies an arbitrage opportunity. So my friends, in this case, if I would have sold the futures, bought the call, sold the put, wherever the market goes in, I'm going to make 452 rupees. If the market comes down to 13,000 also, I'm making 452. If it goes to 18,000, I'm making 450. Wherever the market goes, I'm making that much of money. Right? So that is called call put parity arbitrage. But my friends, it is easier said than done. Why? Can you tell me? Because when I'm executing all these trades, there are expenses, there are slippage cost, there is STT, brokerage. So for individual like us, it is very difficult to do this arbitrage. We cannot make money. Why? Because 452 rupees taxes and other expenses, if I deduct, buying and squaring off, I will not be left with anything. So right now, this arbitrage is done by algo trading firms. Have you heard algo trading firms? Have you heard words like Citadel Investments? These algo trading firms, they have their own hardware and software. This cannot be done by humans. Moment the market, the algo catches the spread difference, it does this equation. Moment the algo catches the spread difference, it does this equation. Am I making sense? Right. Algos are predefined programs. So my friends, if I'm telling you can't do this, Kuldeep bhai, then why I'm teaching you this formula? Why? So let me take you to this call put parity equation. What is the equation? C minus P minus futures equals to 0. Now my friend Kuldeep bhai has got a 15,700 call at 100 rupees. PM Modi announces tomorrow a big package. Nifty open 16,200. Now Kuldeep bhai has bought a 15,700 call at 100 rupees. But there is a huge gap up opening in Nifty. Are you aware that there is a Nifty freeze if the price opens more than 100% for a few minutes Options are not liquid, they are circuit. Who is aware? So my friends, there is a circuit freeze. If it opens more than 100% up, NSE, in order to protect the small investors, opens up with a freeze. Right? So in this freeze, you cannot exit your position till the trading does not start. Now Kuldeep Bhai is very eager to book profits. Right? He is very eager. Now what can be done? So what is Kuldeep Bhai doing? He sells the Nifty futures at 16,200 and he sells the put at 15,700. So he sells the 15,700 put and he sells the futures at 16,200 as per the equation. Now my friends, let us assume that Nifty closes at 17,000 for the expiry. So for the expiry, Nifty closes at 17,000. So what will be the value of Kuldeep Bhai's call? 1,300. Put will be 0. Futures, what will be the value? Minus 800. What has Kuldeep Bhai made? 500 rupees. Now let us assume Nifty closes at 14,500. Call will be 0. What will be the put? Minus 1,200 because he has sold 15,700. Futures he has sold at 16,200. Can you see this? Wherever the market goes, Kuldeep Bhai's profit has been frozen. Let us assume Nifty closes at 15,700. Call is 0. Put will be 0. Futures 500. Yes? Am I making sense? So with the help of this equation, if you have a long or a short position, you can square off. Meena ma'am has sold 15,700 call. Prime Minister announces this package. So what will be the equation? If I shift this equation, what will be the equation? Futures less call plus put will be equal to 0. Am I clear? Is this correct? So now Meena ma'am has sold the 15,700 call. Right? Call is open on a freeze. Meena ma'am wants to book her loss. Why? Because she feels that Nifty can still go up by another 500 points. So what will we should do? She will buy the 15,700 put, same strike. She will buy the futures at 16,200. So let us see. Now if Nifty closes at 16,200, the future is 0. Call is minus 500. Put is 0. Can you see 500 rupees loss booked? Now if Nifty closes at 17,000 on expiry, she makes 800 rupees on the future. Sorry, she makes 800 rupees on the future. In the call, she loses 1,200. In the put, 0, 500. If Nifty closes at 14,000, in the future, what shall she show? She loses 2,200. In the call, what does she do? 0. Sorry, she has sold the call. So she has sold the call, so it will be 0. And she has bought the put. So she will make 1,700. So can you see her loss is booked with the help of this strategy. So sometimes if you have bought a call or a put in any stock or an index and it is becoming very illiquid for the time being and you cannot square off your position, this equation C minus P minus futures equal to 0 or future minus call plus put is equal to 0 will help you to square off your positions. Am I making sense? Is this clear? Everyone? Shashi sir, Srinivas sir, Somesh sir. Is this clear? C minus P less futures equal to 0. Both the call and the put should be of the same expiry. If I shift this equation on the other side, Manas sir, when the liquidity comes, you can square off this position. When the liquidity comes, you can square off the position. Or on the last day, this equation will be 0. On the last day, this will close at 0. Right? Is this clear? Shaikh ma'am, is this clear? Gunjan sir, is this clear? So you're very quiet today, Gunjan sir. Right. Good. How are you, Gunjan bhai? How is it going? Good. Now we come down to futures and option strategies or combined strategies in cash market along with options. The first strategy is called covered call. Covered call is a strategy where an investor, so these are not for traders, these are for investors. He buys or holds an instrument in the cash market and he then sells the call of the underlying asset to generate income. Right? He buys an instrument in the cash market or equivalent of that in the futures and sells the call of the underlying asset to generate income. So let's take an example. Shaikh ma'am is bullish in Reliance. Shaikh ma'am has bought Reliance futures. At 2118. Now Shaikh ma'am, this is her original position. She can either buy 250 quantities in the cash market or she has bought one lot of futures. Now Shaikh Ma'am feels that though Reliance is bullish, but for the next 20 days, Reliance might not cross 2,200. So what is she doing? Is selling the 2,200 call. So when she is selling the call at 45 rupees 70, what does she do? She gets the premium. So break-even cost falls from 2118 minus 46. 2072. 2072. The break-even point. Right? So below 2072, Shaikh Ma'am has unlimited loss. But above 2200, the profit of Shaikh Ma'am gets frozen at 31,850. Why? Because she sold a call. So this was the original position, long futures. This is the new position she is added. She sold a call. So what is the net position? Unlimited loss, limited profit. Can you see this? Right? Now, is this a good strategy? My profit is limited above 2200. At 2200, I only get 31,000. On the other hand, Kuldeep bhai, if the market goes below my break-even point, that is the future price minus the premium received, my loss is unlimited. Is this a good strategy? You will be surprised, Manasta and others. This is the most popular strategy done by the HNI and the institutional investors. This is the most popular strategy done by the HNI and the institutional investors. Why? Please understand this very carefully. How much are you receiving? 45 rupees. This is for how long? 1 month? So if I'm continuously doing this for 12 months, how much am I getting? 500 rupees approximate, little more. What is the price of Reliance? 2000. Into 100. What is the percentage returns? 25%. Yes. So just by doing this, I'm bringing down my cost by 2% every month. And please understand, I am bullish as an investor for the next 6 months. So only on blue chip stocks where you are bullish for the next 6 months as an investor, where you feel that the upside is limited due to any factor, you can do this covered call strategy. So every month, so let's take an example, Meena ma'am, Reliance closes at 2300. So in the futures, what will I make? 184 rupees. In the call, what will I lose? 100 rupees. So I will square off both and the last day, 84 rupees profit. How much did the premium I received? 45. So 84 plus 45 will be my net profit. So 31,850. 129 into 250 shares. Am I making sense? Am I clear? So this covered call strategy, when should you do it? Blue chip stocks, not ordinary stocks. You are bullish for the next minimum 3 months to 6 months. And you feel that the upside of this stock is limited. So you are selling the call to generate monthly income. But this monthly income is substantial. So you can either buy a futures or you can buy Reliance delivery in the cash market. Is this clear? So the covered call strategy, either you can buy one lot of futures or same quantity in cash. Sell one lot of calls, same quantity, having the same expiry. This strategy gives limited profit, but the losses are unlimited. Where have you seen this? Have you seen this somewhere? Yeah, Bhavna ma'am, you can keep forwarding the call. You can keep, when the June gets expiry, July gets over. If you are bullish, you can sell the August expiry call. Generate the monthly income. Where have you seen this? Where have you seen this? So what is it? How's a long call like this? What is a long put like this? What is a short call like this? What is this? What is this payoff? Is it a short put? When I'm selling a put, limited profit, unlimited loss when the market goes down. What is the call put parity equation? C minus P minus futures equals to 0. Is this the equation? So if I shift this, F minus C, what is it equal to? Minus P. So can you see the world is so long? I taught you this equation. And you just use this equation here. You're buying a future, selling a call. As a trader, you don't need to do these two equations. If you sell a put as a trader, it is nothing but similar payoff to a covered call. So if you're a trader, you don't need to buy futures. You don't need to sell call. If you're bullish in Reliance, you can just sell a put. Am I making sense? Others, C minus P minus F is equal to 0. So if I shift the F here, C minus, it is nothing but minus P. So this is what you are seeing. See this? Limited profit, unlimited loss if the market goes down. Is this making sense? So covered call for an investor, no doubt. If you are trading in blue chip stocks and you have purchased the delivery and you're bullish for the next 6 months, if you're selling the call, it will give you very good money. Monthly income done by the HNIs and institutions. Now we come down to the next one, marriage put. My friend Kuldeep Bhai has bought Reliance in the cash market. Okay, He has bought Reliance in the cash market. Now there is a threat to India-Pakistan war. Now Kuldeep Bhai is very bullish in Reliance. He does not want to sell it. Why? Because he feels Reliance has a very bright future. But at the same time, next 15-20 days, he feels that there is a threat of war. You remember we did hedging. So what will Kuldeep Bhai do? In order to protect his position, he will buy one put of 2100. So he's buying a futures and he's buying a put. So what has happened when you're buying a future? It is like this. So when you're buying a put, you're protecting your downside loss. So the buying of a put is like this. So when I combine this, what do I get? So this, my break-even point will be added 2118 plus 63. So above 2182, I will have unlimited profit. And my loss is 18 rupees plus 63, 82 points into 250. Lovely Rahul Bhai, can you see this? What is the equation? Future plus put. So what is the equation I taught you? C minus P minus future equals to 0. So future plus put, if I take it, equals to call. Right? So Siddharth sir, generally at the money put is what people buy. Some people also buy out of money puts. So what are you doing? You are hedging. So please remember, once you are hedging, you are paying a lot of premium. Can you see you're paying around 3% premium? So moment you feel that now the threat is over, you will remove the hedge. Because if I start paying 63 rupees every month into 12 months, I will be paying around 700 rupees, which is nothing but 40% premium. So if I start doing a hedge every month, for a year I need to pay 40% as premium, which I feel Reliance does not give returns. So I will be at a loss. Only during event or during threats, when I have an existing long position and I feel that because of that event maturing like a threat of war, I will use this strategy. Kuldeep Bhai, this is called a merit put. Against your long position, you are buying at the money or out of money options, hedging to limit your downside losses. Maximum profit unlimited. Maximum loss is limited. This strategy is nothing but a synthetic call. So without the use of call, if I'm a trader, I don't need to buy a futures and buy a put. I can just buy a call. If I'm a trader, I don't need to buy futures and the put. I can just buy the call. Am I making sense? Is this clear? Any question? Meena ma'am, generally people don't sell at the money call. People sell little out of money call because they want to eat some profit of capital gain. So if I'm buying Reliance at 2100, I would like to sell 2200 call. Yeah, you can do it later also, Bhavna ma'am. Why? Because I want some capital appreciation. Yes, Bhavna ma'am, you can sell later when you feel that now the upside is done. I agree. Is this clear? Now we come to the last strategy of the day, caller strategy. In a caller strategy, what are you doing? You are buying something in the cash market. So you're buying +1 or futures cash. You are selling the call and you're buying the put. So it's a combination of covered call and married put. So you are buying in the cash or the futures, you are selling the call to generate income, and you are buying the put for protection. So this strategy, buying cash or one lot of futures, selling one out of money call, buying one at the money or out of the money put. So this example, if you see, you have already bought the put, now you're paying the premium. So what do? In order to compensate, you are selling the 2200 call. So what happens? The premium you are receiving from the call, you are offsetting with the premium paying for the put. But still you're paying a net premium of 17, 18 rupees. Can you see this? You're still paying a net premium. But can you see your maximum loss has come down? But at the same time, your maximum profit is also frozen. You don't have unlimited profit. So above 2137, your profit goes to 2200. From there, your profit gets frozen. And below 2100, your loss, maximum loss is also frozen. Limited loss, limited profit. So Siddharth sir, when you are bullish, but because of certain events, you feel that market can fall and upside is limited, you will do this type of trade. You will do this type of trade. So where have you seen this trade? Limited loss when the market goes down, limited profit when the market goes up. Is it bull call spread? +1, -1? Yes. Bull call spread. So if you're an option trader, you don't require these strategies. I've already taught you that. But if you are a futures trader and you want to protect your positions or generate some extra income, you can create these strategies. Bull call spread is for options. Caller strategy is for those people who are future traders or using cash market and options combinations together to hedge the positions. Wow, we have completed everything. All major strategies are done. So can you see the payoff? Wow. So let us see what did we do. You remember bullish, bull call spread. Bull put spread. Bull call ratio back spread. I think so. We did this last day. I think so. This is all clear. Mirror opposite for the bearish. Bear put spread. Bear call spread. Bear put ratio back spread. Is this clear? These are the 6 option strategies which we did for directional, bullish and bearish. Now, long straddle, long strangle, we did it. I have already discussed, if the market falls, these strategies will make money. If the market goes up, these strategies will make money. Long straddle, strangle, big movement either direction. Short straddle, short strangle. Narrow range movement. Narrow range. Market moving in a range. Butterfly. Condor. Iron condor. Range and a directional strategy between 2 areas where I can predict. Right? And calendar spread. Near to the butterfly, condor, calendar spread near to the expiry. And I must know which is the range. Right? So fly condor and iron condor are another variation where I know for a bigger period I can create the strategy and the range is much wider. The range is much wider. Right? Good. And now the last 3. Covered call, married put, caller strategy. And the most important part, very nice poem by Frank Collins. When things go wrong as they sometimes will, when the road you are trudging seems all uphill, when the funds are low and the debt are high, and you want to smile but you have to sigh, when care is pressing you down a bit, rest if you must, but don't you quit. Life is queer with its twists and turns, as every one of us sometimes learn, and many a failure has turned about when they might have won had they stuck it out. Don't give up though the pace seems slow. You may succeed with another blow. Often the goal is nearer than it seems to a faint and a faltering one. Often the struggler has given up when they might have captured the victor's cup. And they learn too late when the night slipped down how close they were to the golden crown. Success is failure turned inside out, the silver tint to the clouds of doubt, and you never can tell how close you are. It may be near when it seems so far, so stick to the task when your heart is hit. It's when things seem the worst that you must not quit. In markets, very testing for us. New things. Our expectations are high. And that is why we fail in the beginning. Right? What is important is not to quit. Keep fighting and you will succeed. So congratulations, friends. we have completed all the strategies. And tomorrow we have the last session in theory where we are going to learn about option adjustments, option repairs, Max Pain theory, trading rules, mistakes option traders make, volatility skew and smile. And we will hear all your voices. So tomorrow be there with your mic on. I want to hear all you guys. Kuldeep Bhai, the matrix should be in your mind. Anything in the book, not helpful. But as you say, we will sow. So Kuldeep Bhai revised this all today, and there was some homework given to you. In case you have forgotten, please bring it back tomorrow. Right? Any questions? Great. So here we are, friends. Manasa, everyone has to make their own decisions. You have to identify your points. I've taught you one strategy. So whenever next time you get that strategy, execute. If you have missed the trade, don't be in a hurry to enter at a later time. Timing is also very important as a trader. Right time and right decision. We have the live class on Wednesday. Yes. So Rahul sir, how is it now? How is your Josh? Good. So this journey will be challenging. You will fall a lot of times. There will be confusion, as Bhavna ma'am said, which strategy to use when. Comes, as you travel the journey, things will become clearer. So learn to take small steps. That's why we did the short straddle intraday. When you keep doing that short straddle trade intraday every day, your confidence will start to pick up after 10 trades. That is why I gave you the momentum setup. So when you see this ROC going up, you know that there is buying going on. You can enter. So these are small ways to pick up things. Right? Yes, Kuldeep Bhai, I'm always there. So biggest happiness comes from within. Start looking inside you. Once you know your character well, you will understand the markets better. On that note, thank you all. See you tomorrow with the same enthusiasm, same motivation to be better traders. All the best. Take care. Bye-bye. See you.